Hello, Happy New Year. Patrick Walchuk here with financial analysis on a property that sold in December of 2025 in Ottawa. We're filming this at the beginning of 2026. And as usual, we're going to take a building and look at the financials and interpret those financials for you. So in this case here, this is a multi-unit, or it was a 4-unit exactly. It was, call it the eastern part of Ottawa. And again, it sold in December. So I believe I was in this building. It had been on the market forever, and it finally sold. So it was listed at $875,000. Sold price was $840,000. The scheduled rental income was $65,000. The effective rental income would have been $62,700. The operating expenses on it were $14,700, and when you factor in maintenance and management, it takes the total operating expenses up to almost $21,000, which gives us an NOI of $41,800. So we know that stuff. What does that mean? So that gives us a cap rate of 4.98, and this is becoming more common. Investors last year, they just wanted a higher cap. The operating expense ratio was actually pretty good, at 33%, average to low. It sold for 13 times the gross, 20 times the net. That's good. Now, an interesting thing about it is that it only took a 22% down payment in order for this property to cash flow positive, which is really quite low, even on a 4-unit building. Now, if you purchased the property and you had a mortgage at a rate of 4%, we're showing you what your annual and your monthly mortgage payments would be annualized. They're $41,000 and change. So you can see that with that, we have a positive cash flow of $432. So I'm a little surprised that it went. I shouldn't say I'm a little surprised. The property itself was on a nice lot. It had good parking, but the inside needed a lot of love. It had deferred maintenance, and the tenants weren't necessarily what you'd want to inherit. So that, I think, could partially explain why you could buy the property with only 22% down. Thank you for watching.